Broadcasting from the Investor Hour studios and all around the world, you're listening to the Stansberry Investor Hour. Tune in each Thursday on iTunes, Google Play, and everywhere you find podcasts for the latest episodes of the Stansberry Investor Hour. Sign up for the free show archive at investorhour.com. Here's your host, Dan Ferris.
Hello and welcome to the Stansberry Investor Hour. I'm your host, Dan Ferris. I'm also the editor of Extreme Value, published by Stansberry Research. Today we'll talk with William Cohan. Cohan is the author of several books. Today we'll talk about The Last Tycoon, the secret history of Lazard, Frères and Company, where he spent several years of his career. Huge high drama. It's really cool. You'll want to stick around for it. This week in the mailbag, not a lot, just two questions, one about real estate and another one about the Federal Reserve and inflation. In my opening rant this week, we'll talk about stocks, bonds, gold, silver, volatility, and the man who controls the stock market. That and more right now on the Stansberry Investor Hour. I control the stock market. No, I don't control the stock market. That's what Dave Portnoy, this guy who apparently sold Barstool Sports, a sports website. I don't even know what it does. I don't go there. I'm not a big sports guy. But he sold this thing for $400 million, and he's now fancies himself a stock market guru. He says he's making $50,000, $100,000 a day in the market. He says stocks always go up. Short sellers should be investigated by the SEC. I mean, he's like, he's such a sign of the top. I can only direct you to his Twitter feed, Dave Portnoy. Check it out. But he tweeted earlier this week, he's always saying things like, I got the stock market in my back pocket. I got this stuff. I'm better at this than Warren Buffett. All of this kind of stuff. And this time he says, I control the stock market. Now, obviously, Dave Portnoy does not control the stock market. It's just a further sign. It's things people say at the top. Now, you'll never catch me calling a top, but these are things that people say at the top. This is the kind of stuff that happens when markets just go up and up and up. And as I'm talking to you, what's going up? Well, stocks, bonds, metals, and volatility, everything. It's all going up as I'm talking to you. You've probably seen the moves in silver. Talk about that in a minute. But first, let's talk about the S&P 500 versus the 10-year Treasury bond. I think this is probably going to wind up being a somewhat important relationship. I mean, it is an important relationship, right? When bonds stink, stocks get more attractive. So when the 10-year is yielding well below 1%, around 0.6% recently, then the yield on stocks is like, I think it's like 5 times that now. So, well, that looks a lot more attractive, doesn't it? But what are you really saying when you say that? What are you really saying when you say, well, stocks are really, really attractive versus bonds? What you're really saying is that bonds stink, but stocks don't stink as much. That really is what you're saying. And in fact, right now, stocks are priced for a decade of flat to slightly negative annualized returns. So to say that they're more attractive than bonds ain't saying a lot. And there's another relationship. We have to give a hat tip to Mike Green at Logica Funds, who is like, he's like one of the up and coming, really intellectual guys in the finance world. I understand about 50% of what he says, but I find all of it fascinating and some of it very insightful. He's worried about things like passive investing getting too much of share of the total float in the stock market. And for example, he pointed out, we talked with Greg Zuckerman on the program several episodes back. Really good. We talked about his book about Jim Simons and the folks at Renaissance, this incredible quant firm. And Mike Green was saying, one of the things in Renaissance, one of the hardest things that they have to deal with is dealing and quantifying their own effect on the trades they're doing. So as they put money to work in the trades that they find, they affect the market for those securities and those assets. And then that has to feed back into their computer programs, right? So, and that's one of the very, very hard parts for them. And they have like a few tens of billions under management. I think the whole thing is like 50 or 70 billion or something like that. I don't even know. Under 100 billion, right? So Mike Green was saying in this one interview I saw, he said, well, what about Vanguard and BlackRock? They have trillions under management, several trillion between the two of them. I mean, even if it's a few trillion, it's trillions, right? A trillion here, trillion there. Pretty soon you're talking real money. So what happens if that has to unwind? And he offered to debate them on a podcast. He said, I'll debate anybody at Vanguard or BlackRock about how they unwind, if they need to sell, what happens? And he says they're never going to do it because there's nothing in it for them. But one of the things that he pointed out was as the 10-year yield falls, meaning the price of bonds rises, the collateral becomes more valuable. People use these things as collateral to do levered trades. So as the collateral becomes more value, what do? Well, your algorithms and things say we need to lever up more because the collateral's worth more. We need to borrow more and buy more. But what happens when you're no longer getting a positive yield from your 10-year bonds that you're holding? What if it goes to zero and negative? Well, then you're paying to own these bonds, and you don't want to do that. So maybe it starts unwinding. I'm not saying these things are going to crash the stock market or anything, but they could be good for a correction. And, stuff's been going straight up lately. So I tend to worry about that. When you see markets just all going straight up together, I think it's wise. It's sensible to become a little concerned. It doesn't mean you run out and sell everything, but just take the case of, so stocks and bonds are, one's crappy, the other one's slightly less crappy. So yay. And then we have gold and silver that have been doing real well lately, especially silver. I've talked about Mark Petrino before. He's he's one of these guys in Stansberry who worked for Steve Cohen. We have all these people who worked for like Cohen and Soros and, Goldman Sachs and all this stuff. It's really cool. And he's thinking that silver needs to take a break because it's just kind of gone straight up. And that makes sense. And other traders are saying, other folks that I sort of listen to are saying, the more this goes straight up, the bigger the correction's going to be. Also makes sense. But I heard one fellow, God, I forget who it was now. I'm so sorry, but I wish I could give him credit. But he suggested that, look, the higher silver goes, the bigger the correction. But when we get this correction, it's going to be the last great buying opportunity. And we've interviewed Rick Rule in the program before. And one of the things that he'll tell you is, at a certain point, and I think we may be at that point. I'm not saying he says this. I'm adopting his little saying. At some point, Rick will tend to say, okay, the easy money's been made. The big money has yet to be made. And that's how I perceive these trader guys telling me that silver's going to correct. And when it does, that's your last big chance to get in. Because all the deep value types, they were getting in 2016, right? And just they'll get in when nobody wants to own the stuff, and they'll stick around for a long time. But, the less sophisticated folks, they wait and they wait and they wait. And then when, you're going to get this one last dip in probably gold and silver and the equities too, gold and silver equities as well. And that'll be like your last big chance to get this stuff to hold on for really big money. Maybe. I don't predict. It just makes sense to me. And I'm certainly not selling. I'm not selling physical gold, not selling physical silver, period. I did own some little near-term at the money call options on like SLV, GLD, that kind of stuff. Just very small amounts of money. But I'm out of that now. I'm just waiting to see if we get a correction here. And I think we probably will. Another fellow on Twitter who I really like, Mike Harris, the way he framed it was he said, look, stocks, bonds, metals, all straight up together. Something's got to give here. And what that means is bonds, and certainly over the last few decades, bonds have been the hedge. You own some bonds for when your stocks aren't performing. They correlate negatively. And same with gold and silver. You own them as a hedge if things go bad in the economy, they go bad in the stock market. You get the picture. So having all of them go up together makes you wonder, makes this fellow Mike Harris, who I really like on Twitter, wonder, and I agree, which one of them is going to give? All of them? Is the stock market going to give out and we'll continue to see strength in bonds and metals? Or will the metals correct and, stocks will be okay and the metals will correct and then you'll get that last great buying opportunity. It's an interesting, for traders, for short-term trader types right now, it's a bit of an interesting puzzle, I think, in the market. And you see volatility up too, as I'm speaking to you. So what is that? Well, that's people buying put options on the S&P 500, right? So they're hedging those gains that they're seeing in stocks. Personally, I'm a longer-term guy. In my Extreme Value newsletter, I think our average holding period is it was right around 1,100 days. I usually check it daily. And right now it's 1,000 days. Yeah, a little over 1,000 days. So that's not like what's going to happen next week or next month, right? That's next couple years. And we have positions that we've had in there. We're still holding stocks we recommended in one of them 2008, 2009, a couple of names. So, longer term, that's a different discussion. But right at this moment, it's a little weird. And when you have folks like Dave Portnoy saying, I control the stock market, it just makes me feel like stocks are overdone. Whether that's short term or whether we finally get the longer term, real bear market that I would think would be around here somewhere remains to be seen. And, there's a lot of good arguments for saying that we won't get that. But look, if you look at the history of the S&P 500, of the stock market in the United States, there's very few times when it's gotten this expensive. Like 2.3, it's headed toward 2.4 times sales. And that's a better gauge than price to earnings, by the way, than PE. Price to sales is better. It's been more reliable over time. And, when it gets up around here, as it's done very few times, it tends to be kind of a big top. And what if we do this? What if all that happens over the next, I don't know, you tell me, 5 years? What if all that happens is that we get these events like we got in March, where all of a sudden the market's down 30% in a couple weeks? It would make sense to me that from this point on, we had this regime of really low volatility, and that appears to be gone. Haven't seen the VIX haven't seen it below 20 in quite a while. And it's been, when it starts to get up around 30, I know the fellow at Hedge Eye, Keith McCullough, says at 40, the market becomes uninvestable because it's just so volatile and crazy. It gets worse. When you get up around 20, 30, it gets more difficult to own stocks and to buy new ones. So, for most people, right? I mean, if value gets created, fine, I don't care about the volatility. I want volatility. I want a big drawdown. But you know how people are. They're in, they're out, they get scared, the market's down 20%, they sell everything. Oh, then the market rallies 40%. Oh, then they get back in after the rally. You know how it is. So it wouldn't surprise me at all to see lots of this kind of volatility in these events over the next several years. And if all that happens is that for the next 5 or, several years, that will be unpleasant enough. And I think it will make, in the end, it will hopefully make stocks cheap enough to be really super attractive again. I'm going to leave you there. It's a weird moment. What happens next is anybody's guess. I'm guessing silver has got to correct, but I also think stocks have gotten ahead of themselves. Like I said, I don't know. This is why you hold a diversified portfolio. Cash, stocks, metals, a little bit of Bitcoin, and your cash will take care of you if all this stuff starts correcting, right? Okay, now let's talk to William Cohan. I have to tell you, I have like several of his books on my shelf. They're all pretty long. He goes into great depth. But as we'll talk during the interview, you'll hear the sense of drama is awesome. I mean, if you can make a financial book into a really great drama, you just want it. You want it to go on for 500 pages. And he does. And it's really, it's great. He's like one of the great financial writers of our time in that respect. So let's talk to him right now. He predicted the downfall of General Motors and the collapse of Fannie Mae and Freddie Mac in 2008. Our founder and my friend Porter Stansberry recently told me he has a very critical warning that investors need to hear. Porter is holding an urgent crisis briefing next Thursday at 10 a.m. Eastern. In this briefing, Porter will explain why he believes capitalism as we know it is in a crisis. What Porter has found will have an effect on millions of Americans and their portfolios. Go to www.crisismessage.com to sign up for Porter's urgent crisis briefing on July 30th at 10 a.m. Eastern. Again, that's www.crisismessage.com. Today's guest is William Cohan. William Cohan was an award-winning investigative journalist before embarking on a 17-year career as an investment banker on Wall Street. He spent 6 years at Lazard Frères in New York and later became a managing director at JPMorgan Chase and Company. He is a graduate of Duke University and received both an MS from Columbia University's Graduate School of Journalism and an MBA from its Graduate School of Business. He lives in New York City and Columbia County, New York. Bill Cohan, welcome to the program, sir.
Thank you. Thank you for having me.
So, Bill, before we get to talking about the absolutely wonderful books that you've written, I'd just like to know, at what point in your life, how early on in life, did the financial world sort of beckon you? When did you know that the financial world was for you?
Well, first thought that the journalistic world was for me, and it turned out, it turned out to be that case, and also the financial world beckoned me. So it's like two strands of DNA that got intertwined together. You know, when I was in high school, I was the business manager of the school newspaper, and we made more money than ever before, and that sort of seemed fun and interesting. My father here was an accountant, and my uncle was an accountant. My grandfather was an accountant, and I used to go down to their office on Saturday during tax season, and they had these big adding machines that I used to love to play with. You know, they're the absolute opposite of a small little calculator or a little computer. They were these big lumbering machines, and I used to love to push the buttons and watch them, spew out all sorts of big numbers. But it was probably, I got interested in the financial markets when I was traveling with my parents in Japan in the early 1970s. We were on a bullet train, and I was reading a book that Merrill Lynch, a propaganda book that Merrill Lynch put out about how to buy stocks. And not that I did anything about that, but that was sort of the first inkling that I had that there was something about the financial markets and the financial world that interested me.
Was it all the doggone money?
No, I wasn't really, and I'm still not sort of driven by financial rewards. Maybe it was, I remember as I was growing up a little bit more, becoming a teenager in my early 20s, I was always really interested in reading about deals, that would be announced, and then they would appear, big deal would get announced. There's a lot of commotion about it, and this was a time before there was Bloomberg TV or CNBC or Fox Business or anything like that. And you'd wait a day or two, and then the Wall Street Journal would have a big takeout when it was owned by the Bancroft family before the Rupert Murdoch bought it. And there'd be this big explanation and story and narrative about how the deal had occurred and who did what to whom and who the bankers were. And I always used to love to read those things, and then started dreaming about the possibility of writing those things myself. So it wasn't money. It was more the drama of it all, how these deals happened and the mind-boggling numbers involved in terms of the billions of dollars that these deals involved. And, I just first sort of dreamed about writing about it. And then, while I was at business school later, I sort of dreamed about working on them. And then, of course, I ended up working on them and then writing about them. So everything came true.
So tell me about you had this 17-year career on Wall Street as an investment banker. Tell me about your first gig. How did you get that? And I'm just curious, how old were you and what did it look like coming in the door to wherever it was that you first worked?
So I graduated from Columbia Journalism School in 1983 and then went to work at a paper in Raleigh, North Carolina from 1983 to 1985, covering public schools in Wake County, North Carolina. I'd never been to a public school in my life, so it was sort of an interesting opportunity, challenge. Learned a lot about public education. Was making a tiny amount of money as a journalist, embarrassingly small. And my father, kept wondering how it is I'm going to be able to make a life for myself, afford to live, based on being a journalist. And so he always wanted me to go to business school. And I thought, well, I didn't want to go to business school. I didn't even know what business school was about. But over time, I decided, well, maybe if I went to business school, I could get a job writing those articles in the Wall Street Journal that I always wanted to do. And so I went to back to New York, back to Columbia Business School, kept trying to get a job at the Wall Street Journal. They would never hire me. To this day, they've never published anything I've written and pretty much only written bad reviews of my books. I'm not sure why any of that's the case. But eventually I decided, okay, the heck with trying to be a journalist anymore, writing about, M&A deals. I'm going to, I sort of got caught up in the gestalt of business school and everybody wanted to go to Wall Street. So in May of 87, when I graduated from business school, all you had to do to get a job on Wall Street was breathe. And of course, missed all of the opportunities to work at Wall Street investment banks or had gotten rejected from them because I had a quirky journalist background, not I had been a history major and wasn't finance or accounting person by my DNA. And I ended up getting a job offer to go work at GE Capital in New York, financing leveraged buyouts. So, the pay was much, more than I had gotten paid as a journalist. And so I didn't know anything about it. I didn't know what a leveraged buyout was. I certainly didn't know how to finance a leveraged buyout. So I joined this group in New York and just started to try to do my job. Had no idea what I was doing. And that was in September of 87. And then in October of 1987, of course, the market crashed 22.6% in one day. I saw, grown men standing around the Quotron machines in those days crying because their life savings had been hurt very badly. Of course, I had no life savings, so it didn't affect me. And, just tried to do my job and eventually through trial and error, through osmosis, through apprenticeship, through whatever means it takes one to learn what is really an apprenticeship business, Wall Street and M&A advice. And, I eventually learned that job, got hired at Lazard in 1989 as an M&A banker. I was the only associate hired that year. And I really thought I had died and gone to heaven. I mean, I thought, oh my God, how did this guy with no background, how did this guy who survived the Wall Street financial crash of 1987, when all of my classmates who went to Wall Street investment banks got flushed out as a result of that, and I survived, and now here I am at Lazard. I mean, it was like the pinnacle of M&A banking on Wall Street at that time, and I just thought it was infinitely fascinating. But I hasten to add that even though I ended up writing my first book about Lazard, I had no inkling at that time that I was going to do that or I was ever going to go back to writing, so that all came much, much later. But I knew that I was in a very unusual, special place, even though it was a very difficult place to work and completely dysfunctional most of the time.
Right. So I've read a fair chunk of the book that you're talking about, The Last Tycoons, The Secret History of Lazard, Frères and Company, which I have to say, I can't imagine anyone reviewing that thing poorly. I hope the Wall Street Journal didn't pan that book. Did they?
Yes, they did. Yes.
You've got to be kidding me.
The person who panned it has since told me that he apologized. I think they had asked an investment banker to review it, and he didn't like it. I think he'd just come out with his own book and has since apologized. So there you go. But it did win. It was named that same year in 2007, it was named the Financial Times Goldman Sachs Business Book of the Year, which made it the best business book by one measure anyway in the world in 2007. So things work out, I guess.
That's easy for me to believe. Because I'm telling you, Bill, I got into the first 2 chapters of this and I was like, wow. It's an opera. It's a grand story with murder and rape and war and scandal and the inner workings of this incredible firm. I highly recommend it to anyone. I can't imagine anyone panning it for any reason, even the ones you described. So I'd actually like to talk about that a little bit with you, that book, if we may. It's really interesting to me. The first chapter is called Great Men. And you just start using this term great men, capital G, capital M. And, you know, it's easy to pick up the context of what you mean, but I don't think I've ever heard this term used in this context. Is that where did this term come from? Why do you use it? And if you've had any involvement in your career with great men, I certainly want to hear about that too. But where did the term come from?
Well, it was just a term that, believe it or not, people used to describe the bankers at Lazard. They thought of themselves as great men, as time when giants roamed the earth, and they thought they were among the giants that roamed the earth, whether you're talking about, Andre Mayer or Felix Roden, who just passed away, or the Michel David, who owned the firm. These people were essentially so imbued with their own wonderfulness that they thought that they were special, that the advice that they were giving their corporate clients was unparalleled, and that they deserved the very high fees that they received for doing that work. And they deserved to live the lavish way that they were living, which included, big apartments on Fifth Avenue and Park Avenue in New York, and big houses in the Hamptons or in Litchfield County, Connecticut. So they all had drunk their own Kool-Aid, so to speak. And so the thought of great men, well, I was just being reportorial about the way they thought of themselves, and don't forget, I spent 6 years there. So I had a front row seat on it all. Again, I want to be clear. I wasn't taking notes. I never thought I was going to be writing a book at all, let alone one about Lazard. That came, as I said, much later. But, one could not help but pick up this feeling of specialness, of Lazard exceptionalism that sort of pervaded the place. Well, whether most of it, of course, was a pathetic myth, but, they believed it.
So this was Felix Roden's tenure as the leader when you were there. Is that right?
Well, by the time, when I got there in 1989 to 1995, Felix was at the height of his powers. He never wanted to run the firm, so he didn't run the firm. He just wanted to do deals. At various points, he was bringing in like 80% of the revenue, each year. And so he was the most powerful partner at the firm, but he didn't want to get involved in the day-to-day running of the firm, the day-to-day managing of anybody. He just wanted to do his thing, get people to jump at his command, which he was very good at, and, sort of do whatever he wanted to do whenever he wanted to do it. And so in effect, he was the firm, and he was the most important partner at the firm.
Yeah, it's interesting that you tell me that, he didn't want to run the firm, because there's a odd, almost comical scene in the book with a guy named Kim Fennebrusque, and he's asked to take co-management of the banking group, and he's in turmoil about it, because at this firm, being asked to go into management is not the wonderful thing that you would hope it would be. He sees it as a dead end, and I found that so odd. That is atypical, right? That's a weird aspect of Lazard, right?
Yeah, at that time, yes, it was. Basically, on the rest of Wall Street, of course, if you go into management, that just means more power and more pay. Lazard, which at that time was a private partnership, which was, as I said, controlled by Michel David-Weill, the French fourth generation heir to the family that started the firm, that he sort of made all the money decisions. Then there were about what everybody got paid. And then there were other people who sort of ran the firm on a day-to-day basis, which, men who dealing with associates and vice presidents and things like that, and HR departments, but if you were the real power at the firm, then what you did was you just did deals and got other people to work for you and get other people to jump at your command, and that's of course that's what Felix did, and Kim realized that basically he was just going to be a bureaucrat and and in a thankless task, because Felix was going to still be the most important partner, and Michel was going to be the one who made all the decisions about pay and promotion. So at Lazard, that became a very thankless task, and he was smart enough and funny enough to recognize it.
So, Bill, what did you do during your time there?
I started as an associate. As I said, I was the only one hired that year, and they didn't really have any kind of training program. They barely had an HR function. I sat in an office for 3 months without doing anything, because basically nobody knew I was there. Then an associate who was a peer of mine went on vacation, and the partners on the deal that he was working on, basically didn't like him and thought they would use this opportunity of him going on vacation to replace him with me. And so that's how I started working at Lazard. It would happen to be a big restructuring deal, of advising on the restructuring of something called Revco drugstores, which was a big drugstore chain in the U.S. that had been taken private by a private equity affiliate of Salomon Brothers, and then went bankrupt. It was one of the biggest bankruptcies ever at that time. And Lazard had been hired to advise on the restructuring of the company, which is, of course, a very labor-intensive, long-time project where you get paid every month a fair amount of money. And so, I did that and worked on other restructuring deals for 2 or 3 years. And then Michel decided to blow up the restructuring group, to disband it, which was, of course, a big mistake. And then he, brought it back together later. But then I was sort of thrown into the general M&A pool as an M&A banker, and worked on all sorts of things for the next 3 years until, basically it being so dysfunctional and such a difficult work environment that when I got talked to by a recruiter hiring people at Merrill Lynch for the Merrill Lynch's M&A group, I decided to go there. And the saga continued.
Right. So did you have any personal brushes with any of these great men, David Vey or Felix Rohatyn, or even like Steve Ratner or anybody like that?
Absolutely, on nearly a daily basis. One of my favorite stories, and I think I tell this in the book, even though I definitely tried to keep myself out of it as much as possible, was once when I'd been there 6 years and was invited to a meeting with a client, and I was a senior vice president at this time, and the meeting was with Felix and a couple of other partners. So, Felix really wasn't part of the deal team, but the client wanted to sort of hear the great man Felix pontificate about, the economy or interest rates or things like that, which of course Felix loved to do. And so he came into the meeting and he pontificated for about 15 minutes, and then the client asked Felix to introduce his team. And I could tell immediately that Felix was stricken because he knew that he was going to have to try to introduce me, but he had no idea who I was, even though I'd been there 6 years and it was an exceedingly small firm. There were about 75 partners and 75 non-partners. So, and, I'd been there 6 years and we had worked together on things. And anyway, he did not know my name, and someone else had to jump in and say who I was. So I had a big laugh to myself about that. I certainly wasn't going to help him out, that's for sure. It was more fun for me to see whether he was going to have to fall on his sword and how he was going to get out of the predicament he found himself in. But, I of course, Steve Ratner was my boss. I worked with him on several deals. And of course, in the writing of this book, I, of course, spent many, many hours with all of these people, many years later, obviously.
Wow, very cool. You mentioned that, and that is a funny story about the guy not knowing your name after 6 years. And it reminds me of the story in chapter 12 of the book, where you talk about this tree that grows in Indonesia that basically, this, I assume, somewhat beautiful tree that kills everything around it. And the whole chapter is, or a good part of the chapter is about Felix Rohatyn and how he just kind of used up and sort of consumed the people under him. Like he wasn't carrying anyone along. He was kind of using them up, and working for him was kind of a dead end, wasn't it?
Well, I will say that there were many people who felt that way. There were many people who Felix would bring into his orbit. And so they would feel like the warmth of 1,000 suns on them as Felix was showering them with his presence. And before they were used up, they felt very important. And that, Felix would include them because Felix, of course, worked on the most important deals and was the most sought after deal maker. And so, to work for him was considered to be very prestigious at the firm and outside the firm, and looked great on your resume and made you valuable in the marketplace. And then, of course, he eventually would sour on you and move on to somebody else. And so many people who had that experience felt like it was a death sentence. But, ironically, the guy, Ken Jacobs, who's been the CEO of the firm for now 10 years, 11 years, he worked for Felix, although he worked for Felix on deals sort of on the latter sort of 20% of Felix's career. He was slowing down a little bit, and Felix then left to become ambassador to France. He wanted to be Treasury Secretary. He wanted to be Vice Chairman of the Fed. Neither of those things happened. And Ken Jacobs was, I guess, the exception that proves the rule. He was the one who was able, he's a corporate zealot. He was able to absolutely convert his relationship with Felix into power and prestige at the firm, and has been at the helm of it for 11 years, after Bruce Wasserstein took it over and then died. So, Lazard has been very, very good to Ken Jacobs. And he's one of the only ones who sort of fell into Felix's orbit and then managed to benefit from it.
Interesting. Of course, it's not unusual for people to say, well, I worked for this great guy or whoever that everybody knows, somebody even like Steve Jobs or whatever. It's not unusual to say, like, this guy was insanely difficult to work for, but it just struck me as a little odd that it would be, all these folks in the book, at least, that you described, just said that it was, a dead end or bad, even bad for their career. It just, the firm just seems like it's like a stable of racehorses or something, and the fastest horse got all the attention, and the rest of it was just chaos. It had to be impossibly difficult for most folks to get along in an environment like that. I mean, did they chew up associates and spit them out? I mean, was it high turnover?
Of course, yes, which is probably how I got there, in the first place. Partners wouldn't leave for the longest time because, they'd struggled to become a partner. Then once they were a partner, they had all the leverage over the non-partners and could order people around, and they were getting paid so well that, of course, they didn't want to leave. And that became a problem for the rest of us because the people at the top wouldn't leave. And so we couldn't get our shot. I mean, at least at Goldman, you're a partner for 6 or 8 years, and then they shove you out the door so that you can be Treasury Secretary or something. But at Lazard, they didn't do that then, and people stuck around, and it was sort of very frustrating. But it was, that's why I wanted to write this book, to show people, to share with people what it was like to work at this firm, which had this like literally soaring reputation. And was filled with, as you pointed out directly, at the start, great men, but it was utterly dysfunctional, utterly chaotic. It was really quite Darwinian in many ways. And don't forget, this is an era, before it went public, before HR departments, before the Me Too movement. I mean, this was in some ways it brought out the best in these people, mostly men, but also brought out a lot of bad qualities too.
I'll say you have a whole chapter about, you mentioned the Me Too movement. You have a whole chapter about how poorly women were treated, which brutal, absolutely brutal, literally in at least one case.
But the funny thing is that book came out in 2007, and that chapter has been there for 13 years now, and the Me Too movement, nobody picked up on it. It had no impact. None of those people have been held to account. None of those people have still been held to account. And sort of the either before the Me Too movement or after, just nobody cared. It wasn't in the New Yorker. It wasn't in the New York Times. No reviewers mentioned it. So I don't know. Lazard got a big pass on that.
So, by the way, I said I've read a chunk of this. I can't wait to finish it, and I think it's I've read tons and tons of financial books, but and I admit to not having read a word of yours before. Like, I heard your name, but I have to tell you, this is like one of the very best few financial books I have ever read, and I've got Money and Power is another one of yours on my desk, and I'm just about to order For Friends, which I'd like you to talk about a little bit, because this book really hits close to home for you, doesn't it?
Well, I mean, first of all, thank you for those kind words. I think that each of my books, in its way, is about topics that I'm familiar with. I mean, I worked at Lazard. I competed against Bear Stearns and Goldman. I went to Duke, and then this last book is about 4 friends of mine from Andover, where I went, and what happened to them in their lives. And of course, unfortunately, they all died young and tragically. And so, this was my way of trying to both remember them, pay homage to them in some way, but also, try to figure out what happened to them in their lives. It was a mystery to me. After we went our separate ways in high school, this is a time before you could keep in touch with people by cell phone or, heaven forbid, social media or Facebook or any of those things. And so, when you went your separate ways, that was kind of it. And, I'd maybe run into them occasionally or see them at a reunion or something. But basically, we went our separate ways. And the next thing you know, I'd heard that they had died, tragically. And so I sort of collected their stories in my mind and decided that I wanted to, commemorate their lives by writing this book. And it was both an homage to them, but also a serious investigative reporting challenge, because obviously they weren't here to interview. And so I had to triangulate around their lives, what had happened to them, who their friends were, what they did after Andover, their loved ones, their wives, their girlfriends, their friends. So, and then of course had to confront the tragedy of the end of their lives and what actually happened on that day. And so, it was very personal, but also a serious journalistic enterprise, and just like my other books. So, it was a nice way to continue to be challenged journalistically, but also, not have to write about, a Wall Street firm or some big scandal like that occurred with the Duke lacrosse case. So it was sort of a nice different path for me to go down, while also feeling sort of intellectually fulfilled.
Right, and one of these folks is JFK, John F. Kennedy. You went to Andover with John F. Kennedy.
John F. Kennedy Jr.
Oh, JFK Jr. Yes, sure. What was that like?
Yes, it was obviously well known and much written about. So my challenge there was, of course, writing about him in a way that had never been written about before, which was from the perspective of his variety of friends who knew him best, as he was growing up and as he lived his life.
Do you have any? Do you have any memories that you would like to share about any? There are 4 subjects in the book, like you said. Are there any memories of any of the 4 of them that you would like to share with us? Or I'm sensing a little hesitation to talk about JFK Jr.
Obviously, I wrote about these 4 guys in this book, so I don't have any hesitancy. I didn't really hold anything back that's not in there. Obviously, there were things that were edited out just for length and space reasons, which I never quite understand. But the publishing industry has this view about how long books should be if you want people to read them, which I guess there must be some merit in that. I always feel like if you've got your hands on a great yarn well told, that you just kind of want it to go on, not interminably, but go on as long as it needs to go on. But no, I don't think there's anything that I felt was cut out that I feel needs to be shared. There was a lot that I'd written about sort of my own schooling and upbringing and experience at Andover that was more or less cut out. But, I will say that one of my favorite stories, which I do tell in the book with John, is how, we were in the same dorm and I was his senior advisor, one of his senior advisors, and we were friendly, obviously. And his mother, Jackie, who of course my mother revered because we grew up in Massachusetts and revered the Kennedys, and she used to write letters to John, in her handwriting on like regular, small, ridiculously lined paper, nothing fancy at all. In fact, the opposite of fancy. And he would get these letters and toss them into the wastebasket. And I don't know, I happened to be, in his room one day when he was tossing away some of these letters, and I thought to myself, no, these can't be tossed away. So basically I reached in and grabbed a couple of them, which I still have, and then preserved them. And so now I sort of have these handwritten letters from Jackie to John, neither of whom are around anymore, that, are very sort of precious, to me, even though they don't really say much or anything. They're just like a letter from a mother to a high school son. But, that's the kind of thing, in many ways, I think John was, his plumage, if you've ever watched the Shawshank Redemption, talk about, the plumage being too bright. And I think that John's plumage was too bright for this world. He kind of attracted just too much attention and warped space and time and warped people's behavior. People wanted to get close to him. The star power was just magnetic. And I think that it was almost too much for people to handle. I'm not saying that it was obviously not saying that it was a good thing that he died, but it was, he probably, it's not inconceivable to me that we would be talking about him as president now instead of Donald Trump. So, he had so much wattage and star power and such a spellbinding effect on people like I've never seen anybody before. And I've met Donald Trump and I've met Barack Obama they just don't compare to the star power and wattage that this guy had.
Interesting. Very interesting. I would not have expected that. So we're actually coming to the end of our time, which seems to have passed in a minute. But what I'd like to do, Bill, my next book after I finish The Last Tycoons, I think it's probably going to be your other book, Money and Power, because I love Last Tycoons so much and I want to learn about Goldman Sachs, which is what Money and Power is about. So I'd like to read that and get you back here at some point to talk about that.
Sure, I'd be happy to do that. That'll probably be several months. That's another long book, but yes, I'd be happy to do that.
Yeah, it'll take me a little while. I mean, I got to finish, Last Tycoons first. They're both like 600 pages, just so everybody understands what we're talking about here. But I wonder, with your career and your experience and all these wonderful books you've written, I ask all my guests this one last final question. If you could leave our listeners with a single thought about anything, life, finance, money, love, whatever it is, if you could leave our listeners with a single thought, I wonder what it might be.
That's an interesting question. I'm writing my new book about GE. I remember I told you I had my first job at GE financing leverage buyouts, and and I told you also that I tend to write about things that I know. So I spent 2 years at GE, and I'm not saying I know it pretty well, but I'm writing my book about sort of the rise and fall. And in the writing of that, and I'm still writing it, it's a long process, but in the writing of that, I came across a quotation from Ida Tarbell, who was the great investigative journalist of her day, and she wrote this in 1932, and I think it's a beautiful thought. And so why don't I just read to you this short quote that she writes that I have at the beginning of this new book, and I think that it sort of epitomizes what my life has become all about. And I think, sort of you could put it on my grave and I'd be happy. And so it's here's what she wrote in 1932. I've never been one who felt that the praise of him you believe to be a good man is a shame to a writer, any more than I have felt that the condemnation of a man you believe evil is a particular virtue in a writer. A biographer's business is to set down as faithfully as he can what he finds. That's what I try to do.
Well said. Yeah. Well, you did it like crazy in the Last Tycoons, but I'll get back to you on the other ones as soon as I can.
Well, you can imagine not everybody is happy with what I write, but that's the way it goes.
Oh yeah, I'm sure you have a few folks who'd rather you didn't write these books, but we're not among them.
Well, thank you.
Thanks a lot for being here, and like I said, I hope we'll talk to you again pretty soon.
My pleasure. Thank you. Thanks for having me.
Okay, Bill. Thanks a lot. Bye-bye for now. Well, I'll tell you, I feel like we really should have talked for like 3 hours instead of 30 minutes or whatever it was, because just the content of these books that this guy has written, that Bill Cohan has written, is very, very deep. And it's there's so much there, and it's so rich. The Last Tycoons, which are the one that I'm part of the way through, it's like an opera. It's intense, and it's intense for 600 pages. It's amazing. Like each chapter is like its own little book about that topic. And normally a long book will intimidate me. This book is not intimidating. You just dive right in, and it's just rich from page one. So obviously you can hear in my voice, I feel like I've discovered, a cache of gold treasure or something with Bill Cohan's books. And I'm just really excited to tell you about it, and I'm excited that we got to talk to him, and I'm pretty sure we're going to talk to him again. So I hope you enjoyed it. But let's look at the mailbag now. When my friend and colleague Steve Sugarud talks, I listen. Steve predicted the rise of gold in 2003, the top of the dot-com bubble in 2000, and he even called the bottom of the Great Recession in 2009. Steve is once again pounding the table on a new prediction. He believes that a mania will hit the U.S. stock market and take most investors by surprise. He said that thousands, if not millions of dollars will change hands as a result of the anomalies he found in the market. If you want to find out how you can profit from Steve's prediction, he has laid everything out in a video that just went viral. Go to www.investorhourtruewealth.com to watch the video and find out how you can profit in this roller coaster of a market. I watched it, and what Steve found is astonishing. Again, that's www.investorhourtruewealth.com. In the mailbag every week, you and I get to have an honest conversation about investing or whatever is on your mind. Just send your questions, comments, and politely worded criticisms to feedback@investorhour.com. I read every word of every email you send me. I did so again this week, and I respond to as many as possible. Now, there weren't very many emails this week, and I only saw 2 of them that I thought really would make a good discussion. So the first one is from John R., and I can't read the whole thing, John, but I will read where your question begins here. The question is, I would like to get your opinion on the following. If inflation does occur and investors demand higher interest rates to compensate for inflation, as well as the increased credit risk that could exist in the markets due to the economic impact of COVID-19, couldn't we see an inflationary period where real estate gets absolutely destroyed because real estate prices have actually been the result of the current low rate environment? As I look to the future, I see the possibility of an anomaly where inflation rates are increasing, but the value of real estate is rapidly decreasing due to a high rate environment. The demographics of boomers no longer need homes, and the possibility of higher taxes due to weak municipalities. I would love to hear that I am wrong, but if you think I am correct, what is your opinion on the best way to prepare a profit? Thanks, John R. Okay, John, I'm not a predictor. What you say, there's a wide range of outcomes out there that nobody's considering, and you're considering one that most people don't, and that's a good thought exercise. What tends to happen with rates, just historically, right? I don't know the future, but historically, what tends to happen with rates are the symptom. Think of them more as a symptom than a cause, right? People buy bonds and rates go down way low when they're afraid of what? Of asset values falling on other things, right? And then rates go higher when asset values are increasing and there's a demand for money, right? Higher interest rate means there's a demand for money and people are competing for money. So what really tends to happen is in these things is that, people don't mind paying the higher interest rate because they think they see asset prices inflating, right, and rising. And I think, if we see a classic kind of a setup, that's what you get. But you point out the demographics of boomers, baby boomers, basically all the folks who were born in the post-World War II baby boom. They're aging and no longer need, you say they no longer need homes. I get what you're saying. Maybe they're downsizing to smaller places or moving into an apartment or something like that. But they're not putting a bid under houses the way they used to. The millennials are a larger population cohort now than the boomers. So they're young, they want to have families, they might have different values. Maybe they don't want to own a 4,000 square foot monstrosity or something, but they will want some kind of a home that somebody's going to build and some bank is going to lend them money to buy it, right? So, I tend to think that maybe this is an unlikely scenario that you're spelling out here where we're seeing asset prices inflating and yet real estate is rapidly decreasing because you're saying it was caused by a low rate environment. I tend to think of the low rates more as a symptom than a cause that way. Although I know, they are a cause in a big way. But it's a good question. That's all I got for you, John. I hope it helps. The only other question here I got is from Michael O. Let's see. Let's just get down to his question. He says, you've had a few guests on, most recently Cullen Roach, who proposed the idea that the actions of the Fed are not inflationary since they are just swaps of one type of asset for another. To me, it seems that this idea of an asset swap misses the main point, that one of those assets has been newly created from nothing. If the Fed swapped existing dollars on its books for bonds, then leaving aside the money multiplier effect on fractional reserve banking, it would be a straight asset swap. But when the Fed is adding new money to its balance sheet and then swapping it for bonds, it is not a neutral asset swap. Roach saying that it is the Treasury's actions that are inflationary also seems like sleight of hand. The Treasury issues debt. If citizens were to buy that debt with their existing money, that would be an asset swap and not inflationary. It is the fact that the Fed buys that debt with new money that is inflationary. Maybe there is something I am missing in his argument. As I said, I want to understand the opposing view, but him saying it is very complicated doesn't cover it. I'm a professor of economics, so I'm confident I could probably grasp it. Really enjoy the show. Keep the faith, Michael O. Yeah, this is all good stuff. If I could point out one thing in all of this, Michael, not all new money creation is inflationary, right? You did mention the multiplier effect of fractional reserve banking, but historically, increasing reserves, playing with reserves, I would say, that has been one of the longest practiced tools in the Fed's arsenal. From the very beginning, from the beginning of the creation of the Fed, November 1914, that's when they actually opened for business. The act was passed in 1913, but since the very beginning, interest rates, and the suite of tools was really, the big tools were really reserves and interest rates. And now they do some other things. But the idea, though, that, if you create more reserves, maybe banks make more loans, and that multiplier effect kicks in, right? And stimulates things. But what really tends to happen is that, rates are low because people are scared of deflation. And when the Fed is swapping, they go into the market and they buy these income-producing securities. And basically, they create cash and buy the income-producing security like Cullen was describing. They're taking income out of the system. That's deflationary. And then they're creating this reserve that, it just doesn't get used. There's no multiplying. The multiplying happens when there's a big demand for money and people are making lots of loans and asset prices are going up and people want to buy those assets. You see, not all money creation is inflationary, I think, that's the real crux of it here. I'm not answering for Cullen, by the way. He might say something different than me, and he's a lot more knowledgeable about macro than me, but I'm confident in what I'm saying. Not all money creation is inflationary. I mean, if that were true, things would be a lot different over in Japan, right? And would have been for the past couple of decades. And then you have this other portion. So Roach saying that it's the Treasury's actions that are inflationary also seems like sleight of hand. The Treasury issues debt. If people buy debt with existing money, not inflationary. If the Fed buys debt with new money, that is inflationary. Not necessarily, Michael. I don't think that's necessarily true, right? Remember, they're removing income from the system. They're not going to take their income and go out and buy. They're not going to Walmart, They're not buying a house. So then we get this new reserve created, which doesn't get multiplied because people are scared as hell and they're not buying stuff. So that is my understanding of the answer to your, that is my answer to your question. I do not speak for Cullen Roach. The man can speak for himself and knows a lot more about it than I do, but that's what I would say. I hope that helps you. And, if it doesn't, write in again. We'll talk some more. Okay, that's another episode of the Stansberry Investor Hour. I hope you enjoyed it as much as I did. Do me a favor, subscribe to the show on iTunes, Google Play, or wherever you listen to podcasts. And while you're there, help us grow with a rate and a review. You can also follow us on Facebook and Instagram. Our handle is @InvestorHour. You can follow us on Twitter. Our handle there is @investor_hour. Have a guest you want me to interview? Drop us a note at feedback@investorhour.com. Till next week, I'm Dan Ferris. Thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email, feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.